Some of the biggest earnings surprises of the year do not announce themselves in advance. They just show up. And the investors sitting in front of their screens with a plan already in place walk away with a completely different outcome than the ones who are reacting in real time. Today we have 5 names that every serious investor needs to understand right now. Not because they are all buy signals. One of them is actually a warning about how fast institutional money can punish even a beloved brand the moment the numbers disappoint. I went through every beat, every miss, every guidance revision, and every technical level for each of these companies before sitting down to record this. By the end of this video, you are going to know exactly what happened, what it means, and what to do about it. If you are serious about staying ahead of the market instead of chasing it, hit subscribe right now. Let's get into it. Stock number 1, Dell Technologies, ticker DELL. Most people still think of Dell as a PC company. That reaction is exactly why this earnings report caught so many off guard. Here is what Dell actually is right now. They are the infrastructure backbone of the AI build-out. Servers, storage, enterprise hardware. When a company needs the physical equipment to run AI workloads at scale, Dell is one of the first calls they make. And the numbers from this quarter made that case louder than any analyst note could. Adjusted EPS came in at $4.86. The street was expecting $2.94. That is a beat of 65% on earnings. Revenue landed at $43.84 billion against expectations of $35.44 billion. They beat revenue estimates by more than $8 billion in a single quarter, and the guidance was not a pullback. Q2 adjusted EPS projected at $4.80 versus the $3 street estimate. Q2 revenue guidance of $44 to $45 billion against a $35 billion consensus. This is a company that beat by a historic margin and then guided even higher. The stock moved accordingly, up more than 25% on the day. Investors who understood the AI infrastructure thesis and got in near $110 are now looking at a position worth 4 times what they paid. Here is my honest concern. After a 28% single-day move on top of a 300% multi-month rally, the risk-reward on fresh capital entering here is not attractive. Stocks that go vertical attract profit-taking. That is not pessimism, that is physics. My takeaway. The thesis on Dell is real, and the numbers proved it definitively. But chasing a stock up 28% in a single session is not investing. It is emotion. If this pulls back to the 350 to 375 range, that is where the better opportunity presents itself. Patience beats FOMO every time. Stock number 2, Costco, ticker COST. Now let's flip the coin completely, because not every report this week was a celebration. Costco is one of the most admired retail businesses in America. The membership model, the treasure hunt experience, the Kirkland brand loyalty. Investors have paid a premium valuation for this stock for years because Costco has consistently delivered on every metric that matters, until this quarter. Q3, EPS came in at $4.93, roughly in line. Total sales of $70.52 billion beat the $69.8 billion estimate, so on the headline numbers, this looks acceptable. But here is what the market actually cares about at Costco. Paid members grew 4.1% to 82.9 million. The estimate was 83.1 million, a miss. That might sound like a rounding error. It is not. For a company where the entire business model depends on membership retention and growth, any softness in that number is a signal. Membership fee revenue growth decelerated. Gross margins dipped 21 basis points year over year. None of these are catastrophic in isolation. Together, they tell you Costco is still excellent, but not growing quite fast enough to justify its premium multiple. The stock broke below key technical support and is now sitting roughly 13 to 14% off its highs. Here is my honest concern. A stock breaking support on disappointing membership numbers is not a buying opportunity, it is a falling knife. And catching falling knives is one of the most consistent ways to lose money in this market. My takeaway: the Costco brand is not broken. The business model is not broken, but the entry point right now is not right. Buyer interest likely shows up somewhere in the $850 to $900 range. Wait for that level, then reassess. Rushing in because something is down is not a strategy. Waiting for the right entry is. Stock number 3, Okta, ticker OKTA. This one deserves far more attention than it is getting in the broader conversation today. Most investors who follow Okta remember the painful stretch. The stock trading near $300 in late 2021. Then the brutal decline, the security breach, the customer trust damage. For a while, it genuinely felt like Okta might not fully recover. Here is the thing. The identity and access management space did not go away. It got more important. As companies accelerate cloud migration and cybersecurity spending keeps climbing, the underlying demand for what Okta does is not shrinking. It is expanding. And this quarter, the numbers confirmed it. Adjusted EPS of 91 cents beat the 85-cent estimate. Revenue of $765 million beat the $751 million expectation, a double beat. And then guidance was solid on top of that. Q2 adjusted EPS of 95 to 97 cents, in line with expectations. Full-year guidance raised, multiple analyst firms moving price targets higher. The stock ripped more than 25% on the day. Here is my honest concern. 25% in a single session means most of the immediate upside from this report is already priced in. The investors who got rewarded today were the ones who understood the recovery thesis before the numbers proved it. My takeaway: Okta belongs on your watch list. The thesis is intact, the headwinds are clearing, but the entry after a 25% gap up is not the right moment. Identify your price, set your level, and be ready when the pullback gives you the opportunity. The story here is real. The timing just needs to be right. Drop a comment right now. Are you currently holding any cybersecurity names? Because the Okta recovery is telling you something important about where institutional money is rotating. Let me know in the comments. And let's get to the 2 remaining names. Stock number 4, Robinhood, ticker HOOD. I know what some of you are thinking. Robinhood, the meme stock platform, the company from that era? Strip the narrative away and look at the actual business. Robinhood has been building towards something that is genuinely more interesting than its reputation suggests. Retirement accounts, credit cards, equity investing. They are not a crypto play wrapped in an app anymore. They are constructing a full financial services platform aimed directly at the retail investor who wants everything in one place. The stock found support in the low 70s after pulling back from a previous earnings move. It has since pushed back toward the $90 range, a move of 25 to 30% in a compressed window of time. And here is the wild card that most investors are not fully pricing in. Bitcoin is sitting near $75,000. It has not yet broken back through the $100,000 level. When that happens, and the structural case for it happening is strong, platforms with meaningful crypto exposure are going to see a surge in activity. More activity means more revenue, and if Robinhood is already pushing toward $90 with crypto sentiment relatively subdued, the upside scenario when sentiment re-accelerates is significant. Here is my honest concern. Robinhood's revenue is still heavily influenced by trading volumes that can swing dramatically depending on market sentiment. If volatility compresses and retail engagement pulls back, the numbers get harder to defend. The platform expansion is real, but still early. My takeaway: the longer-term risk-reward on Robinhood is favorable for investors who understand what they own. The crypto optionality is real. The platform evolution is real. This is not a chase it at 90 situation, but it is absolutely a monitor and position situation. For investors with a 12 to 24-month view, stock number 5, UiPath, ticker PATH. This is the one that most investors scrolled past today. That is exactly why it is interesting. UiPath operates in robotic process automation, software that automates the repetitive tasks that cost companies thousands of hours every year. In an environment where every corporation is looking for AI-driven efficiency gains, what UiPath does sits directly in the path of that spending. The numbers from this quarter were not explosive, but they were telling. Adjusted EPS of 15 cents came in just below the 16-cent estimate. A technical miss, but revenue landed at $418 million against the $397 million expected, a meaningful beat on the top line, and full-year guidance was raised from roughly $1.75 billion to $1.77 to $1.78 billion. Analyst firms are maintaining buy ratings with price targets in the $13 to $15 range. Here is what makes this interesting beyond the headline numbers. UiPath has been under the radar, beaten down, under-discussed, and quietly the fundamentals have been improving while attention has been elsewhere. That setup, improving fundamentals, low institutional attention, beaten down price, is historically where the best risk-adjusted opportunities are found. There is a key technical level at $12.50 that matters. If UiPath breaks through that level on strong volume, it signals that buyers are stepping in with conviction. That changes the conversation around this stock entirely. Here is my honest concern. The EPS miss, even a small one, keeps some institutional buyers on the sideline. Until the earnings delivery is cleaner, this remains a story with upside potential, but not yet confirmed momentum. My takeaway: UiPath is a watchlist name, not an action item today. Watch the 1250 level. If it breaks with conviction, that is your signal. The automation tailwind is real. The setup is forming. Do not sleep on this one. Let me bring this all together. 5 names, 5 completely different stories about where the market actually is right now. Dell tells you the AI infrastructure build-out is not slowing down. It is accelerating faster than even the optimists expected. Costco tells you that even the best business models get punished the moment membership growth disappoints at a premium valuation. Okta tells you that patient investors who understood a recovery thesis before the market confirmed it got rewarded this week. Robinhood tells you the crypto optionality story is alive and the platform is more than people give it credit for. And UiPath tells you that the best setups are often the quietest ones, improving fundamentals, low attention, and a clear technical trigger to watch. Here is the investing truth I want to leave you with. The investors who are winning in this market are not the ones reacting to price moves. They are the ones who did the work before the numbers came out, who understood what they owned, who had their levels ready, and who had the discipline to wait for the right entry instead of chasing something that is already extended. That is the edge, not information, discipline. Do me 3 things before you close this video. Hit the like button. It takes 1 second and it helps this analysis reach more serious investors. Subscribe and turn on notifications so you never miss a breakdown like this one. And drop a comment telling me which of these 5 names you are watching most closely. I read every single one. No sponsors, no fluff, just the analysis. See you in the next one.